Capital markets isn't all about public markets. That's just the flashy part. If you're a company and you need money, you could do an IPO, go through months of SEC filings and investor roadshows and general scrutiny so strangers on Twitter can yell at your CEO. Or you could not do that. Instead, you could raise money quietly away from prying eyes and do private placements, alternative offerings. The backstage invite-only version of capital raising is where companies sell securities to a select group of investors and they avoid the whole IPO circus. This is, in many ways, a more appealing option, and it's growing now these days more than ever. There's less regulations, fewer fees, faster execution. The trade-off is that the securities aren't really tradable, at least not right away, and investors get less disclosure. But if you're a company that wants a bunch of cash without the headache of a full public offering, this might be the way to go. There's a lot of rules for selling in private as well. The big rule is 144A. Think of Rule 144A as a, legal loophole, or lawyers use the term safe harbor. They allow securities to be resold without going through SEC registration, as long as they're only sold to qualified institutional buyers, or QIBs, which is a fancy way of saying big financial institutions with a whole lot of money. So here's how it works. The company sells its securities privately to an investment bank. The investment bank immediately resells them to QIBs under Rule 144A. And because QIBs are sophisticated investors, which means that they can afford very expensive lawyers, they don't need the full SEC investor protection treatment, so they don't need all that disclosure. What you get here is companies can raise capital quickly without going through the full SEC registration process. It's particularly popular for high yield bonds or junk bonds, and for companies that aren't quite ready for a full IPO, but they want to tap institutional investors. Of course, this doesn't mean that you can just make stuff up. Issuers, they still have to prepare something like a prospectus and offering memorandum. And underwriters still do due diligence because no one wants to get sued, even by institutional investors. And for bond offerings, there's often registration rights agreements where the company promises to eventually register the bonds with the SEC so investors can trade them more easily. It's essentially like saying, hey, we'll make this public later, but for now, let's keep it between us. Now, if Rule 144 is for institutional investors, Regulation D or Reg D is for accredited investors, a club where hedge funds, private equity, and rich individuals, who have like $1 million in net worth or making like $200K a year, which isn't too high now, but it's for sophisticated people. The policy rationale is that, if you have money, you can sort of afford to lose money without causing, regulatory panic. And Reg D allows companies to raise an unlimited amount of money from these investors without having to register with the SEC. The most common flavors of Reg D offerings are Rule 106B. So here, you can't have any public advertising, but you can take money from up to 35 non-accredited investors. Although in practice, no one, hits 35 because, no one wants to break this rule. And then there's Rule 106C. You can advertise an offering, but you have to verify that every investor is actually accredited. Reg D is everywhere. Startups use Reg D to raise venture capital. Hedge funds use it to raise money, and public companies use it for quick capital. Pipes. But we'll get to that in a second. Private investments and public open. Now there's a catch. The securities that you sell under Reg D, they're restricted, meaning investors can't just flip them and sell them on Robinhood the next day. They either have to hold them for a while, usually around 6 months to a year, or find a way to sell them under Rule 144, which is different from Rule 144A. Securities law, sometimes it's designed to be confusing. Now, lawyers love using Reg D because it's relatively simple, but they also have to make sure that, no one accidentally advertises a 506B deal and investors are actually accredited. Companies also have to file a Form D, a quick notice to the SEC saying, hey, we raised money under Reg D, don't worry about us, don't come after us. Now, I mentioned PIPE, private investment in public equity. It's when a public company raises money privately. This sounds paradoxical. How can you be public and still sell stocks privately? But it makes sense if you think about it. A company needs cash quickly. Maybe they have an acquisition to fund or they really want some money for some big project. And instead of doing a full public offering, a follow-on offering or something like that, they sell shares directly to private investors like hedge funds or private equity firms. These shares initially, they're restricted, meaning they can't be sold right away, but the company usually agrees to register the shares later so that investors can freely trade them. A registration rights agreement. From the company's perspective, a PIPE is faster, cheaper than a public offering because, no roadshow, no SEC review, just a few big investors cutting checks. But because the investor is taking the risk of buying unregistered shares, they often demand a bit of a discount to the market price, or they want extra perks like warrants. For lawyers, PIPEs involve negotiating the security purchase agreement, ensuring that investors get the right registration rights and making sure that everything is structured properly so that it doesn't accidentally trigger shareholder approvals or violate stock exchange regulations. If a company is already public and it meets certain requirements, it can set up a shelf registration, essentially pre-approving itself to raise capital whenever it wants. Think of it like a corporate line of credit for the public markets. The company files a registration with the SEC saying, we're going to sell securities sometime in the future, and the SEC declares it effective, meaning this company doesn't have to do a full review every time it wants to raise money. And then the company, when it actually wants cash, it pulls securities off this shelf and then sells them. This is useful for ATM or at the market offerings where companies kind of dribble out shares into the market over time instead of dumping them all at once. Instead of pricing a big block of shares at a discount, an ATM lets companies sell small amounts to, good market conditions, reducing the sort of risk of a pricing crash. Now, investors barely notice, the fluctuating stock price, and the company gets capital without market disruption of a, big public offering. Legally, ATMs, they involve an agency agreement with a broker similar to an underwriting agreement with less commitment. And the lawyers ensure that everything is disclosed properly and that investors aren't blindsided by a slow trickle of new shares hitting the market.